Well, greetings, my beloved clients and friends. Wanted to give you an update. It's been a little over a week since I last posted something. So we've had about a nice little 2-month rally from around June 16th to August 16th. And then in the last couple of days, last Friday and Monday, it seems like it's fizzled out a little bit. And I guess there's a little bit of fear that it might have been overdone and that we're not really out of the woods yet. But I don't know. I think it's a little overdone. So the fear is that inflation is still really not in check. And I guess one concern I have about inflation is housing. Because that's about 1/3 of the CPI is about 30% is housing costs. And as rates go higher, as Powell raises rates, I think it puts more inflationary pressure on housing prices because it'll cause builders to build fewer houses, right? Because the cost of capital is up, and it'll cause renters to keep renting even longer and not go into buying houses because the cost of buying a house is expensive. So as more demand for rents go up, well, then rents go up. And so that we could see that as a little bit of a driver of continued inflation if we see rents keep going up. But aside from that, gas has come off, it's high. Buying houses, that part of housing, prices have not been shooting up like they have, and even coming down a tiny bit in some places. And the supply chain imbalances are not fully worked out, but they're being worked out. So I'm not too nervous, just to put it that way. A little bit nervous about what might happen to energy prices in the winter if there's a shortage of natural gas, because natural gas isn't something that you could just send down another pipeline. So, and speaking specifically about Europe and the Nord Stream pipeline that goes from Russia to Europe, Germany in particular. And so I don't know who needs that more, if Europe needs that gas more, or if Russia needs to sell that gas more, right? Because they both need it. Russia needs to sell it and Europe needs to buy it. So because they can't just turn around and build another pipeline someplace else and say we're going to send it to China or India instead. I mean, a pipeline isn't built overnight. So I think Russia's going to have to sell some of it. They need the cash flow. So, but it could be a problem. So those are the two things I'm looking out at. Unemployment's still very low. I'm not super worried. I know there's uncertainty, so that's going to lead to volatility in the short term, but I'm not super concerned. As a matter of fact, we're sitting on a lot of cash right now, and there are 4 companies in particular that we're just waiting for a nice entry point to pick them up, and we're pretty close. So I don't want to say anything until I've already bought it, but I'll let you know. We're pretty companies that are great, fundamentally, long-term going backwards, and long-term outlook going forward looks good. And companies that I've wanted to own, and I think I might have a chance to pick them up at a pretty good price. So that's on the horizon. So that's just a brief update about what's going on currently. But I also want to talk a little bit more big picture today about our approach to investing, and specifically our approach to diversification. Because we run a concentrated portfolio. We have right now 15 to 20 names in the portfolio, And some people would say that's very concentrated. And the people I listen to and that I follow and that I respect and that have had tremendous long-term track records of beating the market over long periods of time consistently have a different approach to diversification. So, and it's approach that I share. And it's not the, if you will, the common refrain. But it is common among those greats that have an amazing reputation of beating the market over time. So I just want to read you a few quotes from some of them, okay? Here's the first quote. "There is one other rule you ought to keep in mind, and that is to concentrate. And not only in the Zen sense. Sweet are the uses of diversity, but only if you want to end up in the middle of an average." That was Adam Smith from the Money Game. Here's another quote. "The whole secret of investment is to find places where it's safe and wise to non-diversify. It's just that simple. Diversification is for the know-nothing investor. It's not for the professional." That's Charlie Munger, Warren Buffett's partner. Here's another one. "Statistical analysis shows that security-specific risk is adequately diversified after 14 names in different industries, and the incremental benefit of each additional holding is negligible. We own 18 to 22 companies to allow us to be amply diversified, but have the flexibility to overweight a name or own more than one business within an industry." Mason Hawkins, portfolio manager with an amazing track record. "Empirical testing has proved beyond a reasonable doubt that the riskiness of a portfolio of 12 to 15 diverse companies is little greater than one loaded with 100 or more." Frank Martin. These are all managers that have done very well with a concentrated portfolio and beat the market over time. "The idea that very smart people with investment skills should have hugely diversified portfolios is madness. It's a very conventional madness, and it's taught in all the business schools, but they're wrong." Guess who? Charlie Munger, very frank. He tells it like it is, and that's his belief. I have some more. "If you can identify 6 wonderful businesses, that is all the diversification you need, and you will make a lot of money. And I can guarantee that going into a 7th one, instead of putting more money into your first one, is gotta be a terrible mistake. Very few people have gotten rich on their 7th best idea, but a lot of people have gotten rich with their best idea. So I would say for anyone working with normal capital who really knows the businesses they have gone into, 6 is plenty. And I probably have half of what I like best. I don't diversify personally." Warren Buffett. Right. And you know, that's one reason why we aren't more diversified. I can't know 50 companies really well and follow them and track them and be on top of what they're doing. But, you know, with the help of my assistant, we can closely monitor and deeply understand, you know, 15 to 20 companies. And know what we're owning and be comfortable with it long term and be able to discern, does this company have the wherewithal to make it through the bumpy season that we're in? You know, it takes a lot of work to figure that out, and we can only do it for a handful of companies. So that's one reason why we concentrate, because there aren't that many great companies, and when we find one, we load up on it. 2 things to remember. After purchasing 6 or 8 stocks in different industries, the benefit of adding even more stocks to your portfolio in an effort to decrease risk is small, and overall market risk will not be eliminated merely by adding more stocks to your portfolio. Joel Greenblatt. "The number of securities that should be owned to reduce portfolio risk is not great. As few as 10 to 15 holdings usually suffice." Seth Klarman, the guy that wrote the book Margin of Safety. that's out of print, and if you try to buy it on Amazon, it's like $1,500. He runs Baupost Capital, has had great returns. We still have 15 to 20 stocks in our clients' portfolios today, consistent with what we've done for more than 40 years. Bill Stewart, top portfolio manager. The more positions you have, the more average you are. Bruce Berkowitz. The idea of excessive diversification is madness. Charlie Munger. You can't make money with a diversified approach. David Tepper. You can diversify yourself into mediocrity. John Neff. Don't buy too many different securities. Better to only have a few investments which can be watched. Bernard Baruch. I think diversification and all that stuff they're teaching at business school today is probably the most misguided concept anywhere. Stanley Druckenmiller. All these guys are like Wall Street legends for their consistent long-term returns. Diversification is always and everywhere a confession of ignorance. Andy Redleaf. Diversification covers up ignorance. Bill Ackman. Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing. Warren Buffett. I believe in diversification for risk reducing, but we don't want to diversify ourselves into ignorance. If we can do 3 smart things a year and nothing dumb, we will be very successful. If we can do 5, that's a home run. David Abrams. An investor is not likely to obtain superior results by buying a broad cross-section of the market. The more diversification, the more performance is likely to be average at best. We concentrate our holdings in a few companies that meet our criteria. Good investment ideas, that is, companies that meet our criteria, are difficult to find. When we have found one, we make a large commitment. The 5 largest holdings at Geico account for more than 50% of the stock portfolio. Lou Simpson. He's the guy that ran Geico's portfolio for a long time and did really good. And yeah, we're the same way. Our 5 largest holdings are probably close to 50%. And they're companies that we believe in long term, that have great leaders at the helm and a sustainable market advantage. Our biggest one is Tesla. I believe that's going to be the company of the decade. So although it's a little bit volatile, I think it's going to create a lot of wealth. And it has created a lot of wealth for our clients already, and I believe it will continue to do so for the next decade going forward. On average, we've owned between 17 and 23 stocks over the history of the firm. Most people would say that seems like it's a risky thing to do, but the fact is that if each individual stock in your portfolio was selected because the underlying business itself was of higher quality, thereby meaning it has lower risk, then the whole portfolio would likely have lower risk. Owning more stocks rather than less is not going to reduce the risk of the portfolio unless the underlying stocks, no matter what the number was, have less risk themselves. But most people really don't understand that concept. David Pollan. There's a few guys on Wall Street that have figured it out, and those are the guys that I've read and studied. I didn't want to study the average guys. I wanted to study the best, and this is what they all fundamentally get. Okay, our primary frontier of risk management isn't wide diversification, but the quality of the individual businesses, their balance sheets, and the people who run them. Chuck Aker. We believe you can get more than adequate diversification from 15 or more stocks. The quality and sustainability of the business is far more important for risk management than how many you own. In fact, we believe that after a certain point, owning more companies increases your risk because you have greater chance of owning an inferior business. That is why the hurdles we set for inclusion in our portfolio are so high. David Davidowitz. I saw this funny video recently, and it was a joke. It was about the CEO of Oreos, the cookie company, right? It wasn't really him, but it was a guy playing him. And he was joking that, his marketing team and his advertising team are coming up with all these different Oreos, Halloween Oreos and football Oreos and thin Oreos and backwards Oreos and all these things. And he's like, stop, just go home. We made the perfect cookie. All we got to do is all we have to do is collect the checks. You know what I mean? And there's a few companies like that made the perfect cookie, like Home Depot or Nike or, Coca-Cola, Starbucks. And all you got to do is cash the check. You know what I mean? And just keep running it well. And they're excellent. Their management, their operations are excellent. If you look at Home Depot, for example, their operating expenses are like half what Lowe's is, and they're in the exact same business on the same street oftentimes. Yet just Home Depot's just run very well. You know what I mean? And it's a compounder. It's a wealth creator over a long period of time. And so there's only a few of those, and when we find them, we want to buy them and hold them. If you find 3 wonderful businesses in your life, you'll get very rich. And if you understand them, bad things aren't going to happen to those 3. I mean, that's the characteristic of it. Warren Buffett. In our opinion, the massive over-diversification that is commonplace in the industry has more to do with marketing, making the clients feel comfortable, and smoothing of results than it does with investment excellence. At Nomad, we would rather results were more volatile year to year, but maximized our rolling 5-year outcome. Nick Sleep. And that's our approach too. We understand that a concentrated portfolio is going to be more volatile in the short run, but we're looking to maximize our rolling 5-year outcome and beat the market by a significant margin over that period of time, which, fortunately, we have been able to do up until now, even including the recent volatility. One last one, and I'll wrap it up. We do not believe that concentrating the portfolio in fewer positions increases risk, as many people may believe. The concept that diversification reduces the chance of loss or reduces risk is certainly promoted by some modern finance theories and by the world of insurance. We have a different view, and our historical record supports our view. That's right. We have a different view. Our historical record and the historical record of my mentors support the view that concentration in great companies, if you know what you're doing, is a great way to grow and preserve wealth over time. So that's just a little bit about our approach and our philosophy and the company that we keep. And I hope it's helpful to you and gives you encouragement, especially in volatile times like we're in right now. So I hope you guys have a great day, and we'll be in touch.